Good morning, excuse me, and welcome to this Monday, December 12th, 2022 edition of Trading Places Live at earningsbeats.com. I'm Tom Bowley, Chief Market Strategist here at earningsbeats.com, and I'll be your host for the next 30 minutes, featuring everything you need to know as you prepare for the trading day ahead. Well, we're starting off a new week, and so far it looks like we'll get off to a decent start. Dow futures currently up 107 points, S&P 500 futures up 15, NASDAQ futures up 46, crude oil prices up about 70 cents, a little over 71, actually almost $72 a barrel, and the U.S. 10-year Treasury yield down about 4 basis points to 3.53%. The 10-year Treasury yield has been moving quite a bit lower here over the last month or two. It seems like the bond market, a lot of times we'll see the yields move down and folks getting into bonds before one of these meetings, the Fed meeting, of course, I'm talking about coming out on Tuesday or coming up Tuesday and Wednesday, because there's a lot of shorting that takes place. Sending yields higher, and then as the meeting approaches, it's okay, sell on the rumor and then buy on the news. And so I kind of feel like maybe there's been a little bit of this movement to the upside in the yield, anticipating some inflationary news. But this seems like a little bit more than just some profit taking right before the Fed meeting. I mean, we've seen this yield now moving lower for, I think we topped back in October. So it's been close to 2 months now where we've gone back down. And we did this back in June through the early part of August. We went down for almost 2 months then, and then came roaring back. And of course, we know what happened after that. August, the yield broke back out again. And September was a horrible month for equities. So we've got to remain on our toes, but we're starting to hear a little bit more dovish talk from some of the Fed officials. We've gotten one pretty big disinflationary report from from last month's CPI. And we've got this month's CPI, the November CPI, coming out Tuesday morning. So there's a lot going on right now as we head into this meeting. I think, I've been bullish since mid-June. It's not that I think the market has to go straight up. It's just that I evaluate risk in the market. And at the beginning of the year, I thought it was too risky to be long. And I thought by mid-June, it was too risky to be short. That was the key takeaways for me. It's about managing risk. And we've seen the S&P 500 struggle to go lower. I mean, you can take the bearish argument and say, well, it really hasn't taken off to the upside, but neither has it gone much lower. There's been a lot of bad news, and the market seems to be handling it really well. So I kind of feel like this is the week where the bears are going to have a chance. If they're going to have a chance to take this thing lower, I think it needs to happen now. History turns on the side of the bulls starting next week. Really later this week is when it begins to kick in. Second half of December, as I've pointed out on several occasions recently, we've seen the S&P 500 since 1950 have a annualized return in the second half of December of more than 35%. First half of December is just a little over 2%. So even though December is a great month, there's no doubt that it's the second half of the month that tends to carry the month. So, if the bears can't get things going to the downside here with a key inflation report and another Fed meeting, I'm just not sure what the catalyst is over the next couple of weeks. I see the market going higher if it can hang on here. So it is December 12th. We're almost at the halfway point of the month. Let's see what happens here over the next couple of days. Anyway, I haven't put your screen up yet. I know probably some of you are questioning why the screen's not up. Let me first take you over to earnings beats. And big thing I want to point out here is that we've announced now that we are having our Market Vision 2023 event. It is on Saturday, January 7th. It is a free virtual event. Anyone can attend. No credit card required. This is part of our give back. We're trying to educate folks. Last 3 Market Vision events, I mean, I don't want to say I've been right on the money, but I've been pretty much right on the money the last 3 years. I think we take a little different approach than most in looking at the market. I've got the fundamental background. I've, of course, got the historical background, but I've also been doing technical analysis for 40 years. And so I think the combination of those three and just studying the history of the market and understanding what causes bear markets and how long they tend to last and all those things, I think really helps. And I try to get that across in these events. So I think you'll find it to be an extremely valuable session. If you don't get your money's worth for this, $0, then I guess we've done something really horribly wrong. But I think you'll enjoy it. So make sure you mark your calendar Saturday, January 7th. And in addition to marking your calendar, you need to register. We're going to reach capacity in this event, especially after the last 3 years, the success of the last 3 years. Make sure you are registered. All right, let's move on. So what happened on a Friday to close out the week? Well, the Dow Jones Industrial Average lost 305. The S&P lost 29. The NASDAQ lost 77. Mid caps down 26. Small caps down 13. On a percentage basis, all of them down anywhere from 0.7% to slightly above 1%. So it was kind of an across-the-board sell-off. And if you were watching the action, a lot of that selling took place right at the end of the day. I think it was a lot of folks just said, hey, I don't want to hold over the weekend. We got some big reports coming up next week. I think that is probably what went into it. We do, like I said a little bit ago, we see futures up fractionally this morning. We'll see whether or not that holds. It's hard to get excited right before the report. I mean, we have seen big drops and also big advances when the CPI report comes out. And quite honestly, I'm not sure which way it goes tomorrow. Tell me what the news is, and I can tell you, I give you a much better idea, but I don't know what the news is. So I think if the news is, if the CPI is higher than expected, I would expect to see a pretty significant drop at the open. Whether or not it stays down is another story because you got the Fed coming up as well. But I would expect the initial reaction to be poor if the numbers are hotter than expected. However, if we get a second CPI number in a row that is below expectations and is showing that there are signs that inflation is moderating, maybe even declining, then we got a whole different ballgame. We saw that 7% advance last month, up 4% at the open. That's what can happen if the report's good. I had a member write in and say, well, what do we do? Should we be in the market? Should we be out? Should we be in the juiced, leveraged ETF, the double, the triple, NASDAQ, S&P? What should we do? Listen, I'm not a registered investment advisor. I can't tell anyone what to do. All I can tell you is what I'm seeing in the market. And I can tell you that I believe the next couple of days are going to be volatile, could be in either direction. And it just comes down to risk. How much risk are you willing to take? These next 2 days are not going to be the difference between whether you retire comfortably or whether you don't. So in the short term, does it matter to you? Does it matter if your account takes a hit? If you want to be in long for the long term, does it matter whether you go down 3 or 4% on Tuesday or up 3 or 4%? Obviously, that wouldn't be a problem. I can't answer those questions for every member out there. That's something that everybody has to decide for themselves. I believe the bottom is in. I said that back in June. Yes, we did go down a little bit lower on most of our major indices back in late September, early October, but it didn't last long. We've traded mostly above that June low since then. And I think the market is just accepting whoever wants to sell, go ahead, sell. I think it's finding plenty of buyers on Wall Street. And I think eventually we turn back to the upside. I've said all along, I believe this is a cyclical bear market. If you know one thing about me, it's that I typically am pretty convicted. I have conviction. I was bearish at the beginning of the year. Cautious maybe is a better word to throw out there. Extremely cautious at the beginning of the year. And once the market started to roll over, that was all she wrote. There was just too many warning signs. By June, a lot of those warning signs had been resolved. Sentiment's no longer an issue. We started to see signs of positive rotation. Some of that's waned a little bit. Some of it's continued. But the huge, rate of change that we had seen over 2 years going into 2022 was unsustainable. I wrote about that yesterday at Stock Charts. Make sure you check that out if you haven't already. There were a lot of issues coming into the year. Those issues have been resolved. Now everybody's looking at the news. Everybody was excited back at the beginning of the year. We were setting all-time highs. You got to look behind the numbers. You got to look under the hood. Yeah, back in June, we were, down 25%, but a lot of the signals had changed. I remain bullish. I'm sticking to that. We'll see whether or not I'm right. S&P's up 8% since mid-June. I believe market's going higher. Could we go to a new low? Sure. Market can do anything at once. And trust me, if it does go to new lows, I'm going to be looking at many signals, trying to evaluate, is it something that's sustainable to the downside, or is it just another head fake before we shoot higher? I just don't think we're going lower. History says this is not the time of the year the market goes lower. Late October through mid-January tends to be extremely bullish. I think, again, these 2 days are going to be critical when we go from there. As far as the sectors go from last week, communication services was the only sector in the green on Friday. 10 of the 11 sectors were down, led by energy. Crude oil prices just getting hammered. Healthcare down 1.25% roughly. Materials down about 1%. Industrials down also close to 1%, 0.8%. Looking across these, though, I don't see technology and I don't see discretionary. And you can see communication services was leading and it was actually up. So, and I try not to take too much from one day here, one day there, 1 week here, 1 week there. It's really about the big picture. But anytime the market goes down, especially the sell-off like we had right at the end of the day, I do feel a little bit better about it if I don't see discretionary and technology and communication services leading to the downside, and they did not on Friday. 10-year Treasury yield. Well, we've got, obviously, I talked about some big reports coming out this week. Right now, I'll give you an update. 10-year Treasury yield was pretty flat, actually down 4 basis points, so it's not that flat, down to 3.52%. As I mentioned, Tuesday, that's the day tomorrow where we're going to get the, November CPI. And the expectation there, I'm going to go in and see if it's changed. Hold on 1 second. The expectation for tomorrow is that the headline CPI number will rise 0.3%. The October number, which was released on November 10th, was a rise of 0.4%. So we're looking for that number to come back, come down a little bit. The consensus range that I'm seeing is anywhere from 0.2 to 0.5%. So I think if it comes in at 2 or 4, close to that 3, I'm not sure we're going to see a huge reaction. But I think if you start getting much further away from that, that's where I think we could get big numbers. If we throw out food and energy, so we strip those out and simply look at the core inflation rate, core CPI, October was a rise of 0.3%. We're expecting that to rise to 0.4% tomorrow morning. That's what we're looking for. Headline plus 0.3%, core plus 0.4%. And the consensus on the core CPI is anywhere from 0.3 to 0.5. 4 is the consensus. So we'll see what happens tomorrow. I wish I could tell you which way it was going to go. There's no way to avoid the risk that I know of. I mean, obviously you can do some things to hedge. If you're long, you could sell some calls against your position just to make sure that, you don't get hammered to the downside. Or, just flat out buy puts to protect your long position. And you can do similar if you're on the short side. If you believe this market's going lower and you think this is a secular bear market, and you think this rally that we've seen since the October low is just, smoke and mirrors, and you're in on the short side, I don't know, you might want to buy a call just to protect yourself. There are ways to hedge, so you don't have to go into this blindly one side or the other. But again, I can't take those risks for everyone else. As far as what I'm going to do, I'm going to probably decide later today. Right now, I've said recently, I don't think that this is the time for leverage. I mean, when you're going into a big report like this, personally for me, I will not be heavily leveraged. I probably won't be leveraged at all. There's plenty of different times for that. I really feel like if you're going in with 2 times or 3 times, and if that's your personality and that's what you believe, go for it. But I think when you're going into a report like this, you have to treat it as though you're sitting at the roulette wheel or at the craps table, and you hope that, the dice go your way. I don't like to invest like that personally. To me, what we're going to get today and tomorrow, tomorrow and Wednesday, is the equivalent of an individual stock getting an earnings report. If you're going to hold an individual stock into its earnings report, you have to be willing to take on a lot more risk. You might hit it, it might be great, but you might take a big loss too. So looking at the next 2 days, that's the approach I'd be taking. It's an earnings report kind of for the market. Do you want to hold? Do you want to be in leverage? Do you just want to be in the spider or the QQQ? Do you want individual stocks? Those are all personal questions I can't answer for everyone else. All right, let's look at the S&P 500. Here's that rebound that I was talking about coming off of that October low. There was the June low that I talked about where I called the bottom. I mean, you can see we went down a little bit below it at the end of September. We bounced. And then mid-October, that was the bad, that was the bad CPI report. September CPI came in hotter than expected. We saw the huge gap down, and then look at that rally. Big buying after a bad report. Then October CPI was right here, was released on November 10th, and we had much lower CPI than expected. And of course, we gapped up 4%, maybe 3.5% on the S&P. I'm not sure. I think it was 4% on the NASDAQ. And then we continued going higher. And I've said one of the things to watch for me on the downside is this support area. I mean, 3,900, 4,000, both were pretty key levels, 3,900 especially, because we've seen so many, key bounces off of support there, or breakdowns and then failure at resistance, and then break back above and then support on selling, and then break back down in resistance. That's where that 3,900 level comes in. So we're still trading above that. We're at 39.34. So we haven't lost that yet. We did move back down below 4,000. though. That's a psychological level, but we've done it so many times. I don't know that it really is that meaningful anymore. It's not a new level. It's a level that we've been at many times over the past couple of years. So I don't know. I think 4,000, it really doesn't take on the significance that, say, 5,000 will when we get up to that level. But here, this I think is 38.50 or 38.60, wherever that open was right there. I'd be watching that. And then you've got the 50-day moving average coming up from underneath at 38.40. These are going to be some key levels to watch. 3,900, 38, I think that's 38.60. I'm pretty sure that's 38.60. And then the 50-day 38.40. That's a lot of different support in a fairly narrow area. So if we get through these next 2 days and we're still above all of that, I'm going to be a little bit more bullish at that point. And that might be when I decide to take a shot with leverage. Now, if we get a low CPI report, we get this huge gap up, I don't like chasing with leverage. I'll just happily, if I'm in the QQQ or the spider or something like that, I would just happily ride it back to the upside. There'll be other times. There are moments when leverage becomes, I think, a better option. Not after you have a big gap up. I don't like to chase. All right. Let's take a look at the NASDAQ 100. Very similar chart. Here's your support, your gap support here. That was at 11,350. You can see a lot of support at or just beneath 11,500. The 50-day moving average is at 11,382, which is slightly above this 11,350. So To me, the biggest level on this chart is 11,350, because if you can't hold there, you will have lost 11,500, you'll have lost the 50-day, and you will have lost gap support. So if the number tomorrow is bad and we gap down and we gap below 11,350 on the NDX, I would expect to see more selling down to the gap support, the October low, though, and maybe we just consolidate a little bit further and then take off. Maybe we consolidate, we break down. Maybe the secular bears are right. I don't have a crystal ball. I don't know for sure. I just don't believe that's the case. I think we go higher. And I'll be talking a lot about the market, and things can change too, by the way. Between now and market vision, I may change my opinion. I mean, I was really, really bullish going into the Jackson Hole meeting and speech, Jackson Hole speech that Fed Chief Powell gave back, I think it was August 26th. And right here, I mean, we had moved up. We'd pulled back a little bit, and this was the home builders. Let me go over here to the NDX. Let me show you the NDX. So here was the move. We were in an uptrend. We'd gone just below the 20. And I remember writing an article as we were turning back up. I think we had 60-minute positive divergences on semiconductors. I think the overall market had a positive divergence on the 60-minute chart. And I remember writing an article saying, we're about to explode to the upside. And very next day, we saw this reversal and move up. And I was like, okay, here we go. And then Fed Chief Powell said, more pain ahead. That was his more pain ahead speech. And look what it did. So we can't just rest on our laurels and say, hey, we're going higher and let's just stay long and let's ignore everything going on around us. I don't think that's a very good strategy. And if Wednesday, Fed Chief Powell comes out and says, we were talking it over and we still think there's a lot of problems here and we're going to continue raising, market might take that and just have a massive sell-off. And depending on what leads on that sell-off and all, we can't just sit back and say, oh, the market's going up. Hey, if it turns lower, we'll react to it. Right now, I'm very cautiously bullish. All right, home builders. So I've been talking about home builders recently. And if you look at the relative strength, this is the key part of this chart. I mean, if we look at the absolute chart, you just see a bottom here. We rally back up to about 1,300. Seems like we're kind of struggling right around 1,300. But there's another part of this chart, and this is really important. I think relative strength. If someone says, okay, what's the most important things when you look at a chart? The first thing for me is price volume, the combination of price volume, the candlesticks. I need my candlesticks. I need the volume bars. I just need to see what the market's doing, because Wall Street can't accumulate and cannot distribute without big volume. So volume is important. I don't care. There are others that disagree with me. They ignore volume. Technicians, many of them, many that I respect, have a tremendous amount of respect for, ignore volume. I don't understand that. But hey, whatever, floats your boat in terms of, analyzing the market, go for it. I think volume is a big part. But anyway, relative strength and the PPO are probably the next two things. And maybe relative strength. I used to think PPO was my next, but relative strength might be next. Probably be close. Let me show you this chart. So if you're looking here, the home builders relative to the S&P 500 bottomed in early April. Notice price action went down for the next 2 months. And then, we've been going up, but we haven't really been going up much. But think about what the stock market's done. The stock market went in and put a new low in October. Right? Home builders didn't. And so you can see that this relative strength, look at where we are right now. We are at the highest level that we have been since back in January, when you look at home builders relative to the S&P 500. Now, when I see that, so I'm always looking at the market, looking at charts, and trying to understand the story that these charts are trying to tell. I have seen a couple articles recently that have talked about, well, home builders are starting to move higher because rates are going up or have been coming back down. And that's true. That's a true statement. But it was before that. It started before that. If I go down here, let's put in one more piece to this puzzle here. Let's put in the 10-year Treasury yield. And so down here on the bottom, actually, let me make this a little bit bigger. All right. So here's, what we're talking about. So here are the home builders moving up. Here are rates coming down. That's undeniable. I think that is definitely contributing. Rates coming down, definitely contributing to a lot of buyers. But rates were going up throughout most of this year, and home construction bottomed on a relative basis back in April. This is a group that's been outperforming the S&P 500 since April, while rates were going higher. That's weird. I think that's telling us that's part of the story that we're being told. When I see home builders going up with rates going up, it tells me rates probably aren't going to stay up. And sure enough, we're seeing them roll back over. If you own a home builder or any company in home construction, interest rates coming down in the future, you would have to say is a positive, right? If you're expecting that in time rates are going to come back down, you would start to want to be moving into those areas. You'd want to own those areas, because when the rates do come down, that should increase their business. It makes housing more affordable. I mean, this is not me throwing out my opinion. I mean, this is somewhat factual, I would say. Rates come down, it makes housing more affordable. More people will buy homes. Anyhow, take from this what you want. But home builders have been rising since April on a relative basis. And I know there are some technicians that all they want to do is just look at the chart and the fact that we're downtrending. Well, you know what? We were downtrending in 2009 and then we bottomed. The chart right now looks pretty similar to what it did at the bottom in 2009. Positive divergence on the weekly chart and still in a downtrend. But late 2009 and into early 2010 was one of the best bull markets we ever had. The weekly charts do still, the long-term charts, if we go back here, still, I mean, if this is the only thing I had to look at in the market, I would look at this and I would say, that looks like it's probably rolling back over. And maybe it is. But here at the bottom, we did have a positive divergence. If you want to go back many, many years, that final low in 2009, we had a slight positive divergence. Lower low, slight positive divergence. So you got to be looking at other things too. This is what I would say if I was talking to a group of bears. If we break this downtrend line, stop making excuses. That would be my words of wisdom. I mean, I think, we're already 8% off the bottom, and I think we're going higher, but that's just me. But if we break this downtrend, I would not be thinking shorting. Not with everything else that's happened in the market this year. And I don't think inflation was ever thought to be a long-term problem. I think there's a lot of media that are saying it's a long-term problem or trying to make a case for it because bad news sells. My gosh, inflation in the 1970s was horrible. So if I can talk about this and make it seem like it's the 1970s all over again, I'll get lots of clicks. I don't trust the media because the media is full of opinions, a lot of opinions, and a lot of them aren't educated. They're not educated opinions. They are biased opinions. They're trying to get clicks. They want you to come over to their website for whatever reason, probably to buy something or to support, show all the visitors. They've got so many visitors, so they can get ad revenue from folks that are putting ads on their site. You have to know, and I've said this before, I know when I write a bearish article at Stock Charts, I'll get triple the views on my articles. Triple, minimum, sometimes 5 times as many. If I wrote an article tomorrow and said, next leg of the bear market has begun, I could get all kinds of folks reading my articles. But if I don't believe that that's the case, is it ethical for me to write that? No. I'm going to write what I see. I don't care if it's bearish or bullish. I'm going to write what I see. I'm going to talk about what I see. Feel free to disagree. Last thing we want to do here today. I do want to, I've been pointing out some of these charts where, the chart list that we provide to our members, giving you some of the good performers and bad, well, not so much the bad performers. I guess we could. In fact, I like sometimes buying the bad performers. If they happen to be strong relative performers, and they just happen to have a bad day or two. Anyway, this is what we'll do for the 3 you must see. I know the market just opened. Let's look at BILI as the first of the 3 you must see. Obviously very overbought at this point. It's made huge moves to the upside. Key overhead resistance up closer to $30. Here's the deal with BILI. I don't think it's a trade because I think there's risk on either side. I think we've got about, $5 or $6 to the upside to get near resistance, but I also think we have $5 or $6 to the downside to get to the 20-day moving average. A 1-to-1 reward to risk ratio to me is ignore, pass, move on to the next stock. I have no interest. Now, if the stock pulls back and it's at $20 or $19, then I'm starting to get my attention. Now it is a fast mover, so you got to be willing to take on more risk because of that. But the reward to risk would set up much differently if this stock's trading at $20. The next one I'll show you is THO, which is Thor Industries. Been trending down here, but it did have a good day on Friday. That was a bullish engulfing candle off of a downtrend. So short term, and we reclaimed the 50-day moving average. So I would maybe expect to bounce off the 50 and maybe go back up, challenge the 20. If we can get through the 20 here, I think 90.92 comes into play. And then the last one I'll show you is actually, let's go to the bottom, take the worst performer. And here was ARCT. Let's pull that one up. That's in the pharma area. It continues the sell-off that it saw on Friday back below the 50. I've marked support here right around 16. It's currently at 16.50. If I was even thinking about buying this stock, which I'm not, I'd hold off. A lot of folks just find a stock they want to buy and they just put in their order. I like to find a spot that I really feel is the spot where I want to see a reversal. So I'd be looking closer to $16 personally. Again, I don't like the stock. I don't really see anything here. We could probably go into, looking at the relative strength, see what there's just nothing here. The stock is trading close to a 52-week low relative to its pharma peers. Pharma's been pretty good, but this stock just hasn't. So after this gap up, maybe eventually we'll go down, put in this double bottom and take off again. I don't know. But recently we just haven't performed well. I would be a little careful with it. All right, let's see what the market's doing and we'll wrap up. Well, we are still up. We're seeing a little bit more strength on the down, the S&P versus the versus the NASDAQ. The VIX up 6% today. And I'm sure some of that has to do with the market getting a little bit more nervous ahead of the big moves tomorrow. Remember, volatility is based on the premium that's paid on the short-term S&P options. So when you're just looking out like 30 days. And so the VIX is telling you what the market is anticipating, the expected volatility. Well, this kind of makes sense to me that it would go up right before we have a CPI report and a 2-day Fed meeting. Do they cause volatility? You bet they do. A lot of it. So as a result, market makers are pricing options much higher. You have to pay higher premiums. Makes perfect sense. I believe once we get past Wednesday, especially if we get past Wednesday and the market's higher than where it is right now, I think you'll see this VIX tumble again. On the other hand, obviously, if the news is bad and we get a big gap down, then we could see the VIX become more of an issue back up into the upper 20s, maybe up to around 30. So the next 2 days are going to be big. And again, how you play it, completely up to you. I can't take that risk for you. I don't want to be responsible for your decisions. I mean, I hate to say that, but that's not my job. I'm not a registered investment advisor. I'm not handling folks' money. I'm giving you my opinion on the market. I've done this for a long time. I do think we're going higher, but I can't tell you what's going to happen the next 2 days. I wish I could. All right. That is it for me. I appreciate everybody tuning in. I'll be back tomorrow over at Stock Charts TV. Again, I just want to mention Market Vision 2023. I'm going to be mentioning this every day until we get there. I think it's the biggest event. Register and make sure you get this on your calendar. A lot of great information. Folks from Stock Charts are going to be joining me. They spend a lot of their time on a Saturday to give you great information. I'm going to hopefully give you some more great information. Mark your calendar and register. Have a great day, everybody. Happy trading.